Hello, and a very good evening to all my friends who are watching this particular webinar. Thank you so very much for joining us tonight. We are starting off a brand new series of webinars every Tuesday night. And the purpose of these webinars is simply something that I have learned from having discussions with a lot of friends, a lot of people in my circle, and a lot of clients, of course. People have a lot of questions. They have some understanding about Australian real estate market, which may or may not be true, and they are a bit unsure as well. So we decided to have this brand new series where you can come and ask any questions, and there's no question which is a stupid question. So we will have these every week. Today is the very first session, and we are starting off today. We are going live on multiple platforms, including YouTube, LinkedIn, and Facebook. And just to make sure that I don't miss out on any comments, I will be looking for your comments here on my mobile app as well. So please bear with me. I am with you, but I will be taking your questions and we will try to answer them as best as possible. So if you are joining live, if you have joined us already, please let us know. Put in a comment over there. Let us know you are there. Say a hello, hi, wave, whatever you want. And if you are watching a recording later on, please let us know as well that you watched the recording. And at any point of this webinar, make sure that you put out your questions, your feedback, because that is what will really help us answer what is going through in your head and also improve our content. So without further ado, what we will be doing over here is while you guys throw in your questions coming through slowly, what we will be doing in the meanwhile is that I will try to keep these webinars probably around 30 minutes long. And in the first 10-15 minutes, I can discuss some of the latest insights of what's happening in the Australian property market, some data potentially, some other insights, what may be happening. A lot of people are asking about interest rates, where the interest rates may be going. So we can possibly talk about that as well, and how different states actually operate. What are some of the places which we should be avoiding if we are looking to buy something, or whether it's a really good time to be buying right now or not. So any question can be thrown into the mix. But before we start exploring those questions, I will probably discuss what's happening in the market right now in the first 10-15 minutes and share some interesting stats, some stories with you, some latest updates from very trusted sources. So that's the idea, to share the latest and the up-to-date data with you so that you are well informed. And in the next 15 or 20 minutes, we can take your questions and see how best we can answer them. So initially, we are planning to have it for like a 30-minute session every Tuesday. Again, we are starting at 6 p.m. Australian Eastern Standard Time, but we are open to suggestions if you want it at some other time or some other day as well. But we can talk about it a bit later. What I wanted to quickly share with you today is something really, really very interesting. So I will share my slide pack very quickly before we jump onto the questions, because this is something that can be a bit people are not sure what's happening, right? So at this point of time, we'll be talking about what's happening in the Australian real estate. And at any point of time, if you want to connect with me and discuss your personal situation, like not on the public forum like this, you can always get in touch with myself and we can have a one-to-one call as well. So you can book a call with me. That's perfectly fine as well. But the idea is that if you're asking a question in the public forum, most likely other people are already thinking about it. So we encourage you to ask the questions in public forums, please, but we also respect your privacy. Having said that, so what is happening in the real estate market right now? So some very quick snapshots over here. Uh, After COVID, specifically, the real estate market has really gone up in Australia, and it sits at around $10.2 trillion in value, which is much, much more than the combined value of all stocks in Australian stock exchange. Now, I'm not saying that you start investing in property and not invest in stocks. I am no one to say that because I'm not a financial planner. That's totally your choice as to what you want to be doing. I'm just sharing the stats around property. Now, real estate, which is more than $10 trillion in value, the loan amount is only 2.2 trillion, which is like 22% LVR. And you must have heard a lot of stories around, oh, the interest rates are high, so the mortgage stress is coming up and the property market may go down by 10, 20, 30%. Well, the actual loan amount is only 22% in total of that value. So, yes, mortgage is high now, interest rates are high, the repayments are causing some stress to the households. That's perfectly understandable, and that is happening right now. But it's not happening up to an extent where you can start thinking that the real estate market will fall down by 20, 30% nationwide. I don't think that's going to be happening because the impact, as you can see, the loan amount is only around 22, 23% out of that total value. So it's not impacting every household. And most of the homeowners, like at least or close to half of the homeowners, have already paid off their home loans. So they don't even get impacted by the interest rates going up and down. They don't have a mortgage, right? They do get impacted in terms of cost of living going up, but they don't essentially have a mortgage. So even if the interest rates go up or they go down, half of the homeowners nearly in Australia have just no impact on their lifestyle. And most of the wealth actually sits in Australian real estate, as you can see, around 57%. So that's a big number, right? That's where Aussies like to put their money in. And if we move ahead, how this market has been performing recently. So here's a very quick graph which talks about how the average property market, the national average has been performing. We saw a bit of a dip overall into 2023, even though some of these states and some of the cities were still doing amazingly well at that time. But there was a bit of a dip, yes, we understand that. And now the markets have started increasing or rising again. Now, whether this rise is happening across all the cities, all across all the states, that's not true. Because one thing we need to understand is that Australian property market is really fragmented. And what do I mean by that? I will explain it to you in a sec. So this is how the different capital cities, the 8 capital cities, have performed over the last 15 to 17 years. And if you see, they don't generally work together, right? A lot of times in the past, you can see that this blue line, which is Sydney, has actually led a property boom across the country, and other cities have followed as well. But the latest property boom, Sydney was kind of really booming around 2023, and that's when it started slowing a little bit. But that is where around 2022 or towards the end of 2022, that's when Perth really started going up in value. A lot of people believe this is short-lived. This won't last forever. Well, nothing lasts forever. That's true. But what I believe by looking at the data is there's still a lot of growth remaining in Perth as long as you are in the right areas of Perth. Not all of Perth will keep growing, but there's a lot of demand still there with a lot of limited supply in Perth, which will keep pushing the prices higher. If you look at some of the other cities over here, for instance, we have Melbourne over here. Back in 2009, Melbourne was really leading the way in terms of capital growth, right? But then Melbourne has seen its downturn. It had some negative growth in 2019, even before COVID actually hit. Then in 2020, there were lockdowns. 2022, 23, it really went down. And now around in the first half of 2024, it has had negative growth again. So anything below this horizontal line is negative growth. So the purpose of sharing this data with you is not all the cities perform in the same way. They can actually vary a lot from one another, and it's all about what is happening at a macro level, what is happening at the local geographical level, what's the local economy like, what is the local demand and supply like, what is the local job market like. Once you can analyze those things, then you can pretty accurately be able to understand how one market or one city is really different from the other. That's why we suggest people, if you want to buy something, try and diversify yourself, right? Don't buy everything in one city, because that is when, if that city slows down, your properties will not have solid growth for the next 3 to 4 5 years. So it's always good to diversify, because someone had that question and I saw that coming as well, that where we should be buying. Again, it's a very strategic and a very personalized question. I'm not saying that you should go and start buying in Perth blindly, because you can make mistakes over there as well. There's a strategic process behind it as to how you can target a location and how you buy over there. But a bit more on that maybe at some other time. I'm just keeping an eye on the time as well. Now, what is happening, a big myth which is out there, and I want to talk about this myth. A lot of media houses, media channels are saying the property prices will probably fall 20-30% with the high interest rates, right? These were the same outlets, I remember, who were talking about price going down when COVID had hit. The prices actually went the opposite way, right? So, as you can see on this graph, the people who are falling behind in their mortgages in Australia is probably somewhere around 0.8, 0.9%. And that was a survey which was done in March. So it's like 6 months ago by RBA Financial Stability Review. And this is a very trusted source. And this, even though it has risen a little bit, it's close to 1% or slightly over 1% right now. But it still shows that interest rates were rising up until November last year, which was 10 months ago. And even in that last 10-month period, we have not got a lot of mortgages falling into arrears, which is a reason. There are few reasons behind it. You may be asking what are the reasons. One thing is APRA, the regulatory authority around lending, has a very strict buffer rate. So they will actually analyze you at least 3% above what the market, what the interest rates has been offered to you by the bank, so that if any further fluctuations happen in the interest rate, you are well covered to pay that off as well. Plus, people have had good savings in Australia, which are not the same right now because cost of living has gone up, mortgages have gone up now. So the saving amount is not the same as it was around COVID time, but still their savings are quite sizable. And if you're thinking, should I buy the property? Should I not buy the property? Should I just wait? The demand and supply gap is so huge in most parts of the country, that if you can plan your cash flow properly as to how your cash flow will work for the next 2, 3, 4 years, I think there's no point for you not to consider buying right now. The main thing is people don't understand their future cash flow, and that is what really prevents them or makes them feel that they should not be buying property, or it's not a good time to be buying property right now. So it's all about planning that cash flow. Again, we can talk more about it separately. We have a question over here. Thanks, Ed, for your question. And the question is, if I have a budget of 800K, where should I be buying in Sydney? Because I am looking for a quality investment. So there can be 10 different answers to this question, because depending on your actual situation. So I'm just assuming right now that you want to buy a high quality investment, and by high quality you mean not just high rental but also high growth. For 800K, 900K in Sydney, you can get properties which will have good decent growth. They will grow by 50 grand or 100 grand every single year potentially, but where they will be lacking will be the rental yield. So if you are someone who just wants to buy one property and stick with it, probably yes, you can still target some areas of Sydney, maybe Western Sydney. Probably you will get rundown properties, or you can target some townhouses in some desirable areas in Western Sydney or Southwestern Sydney. That's where you can look for townhouses. But maybe around Liverpool area, I would say is a good area for that. Maybe around Austral, be careful that Austral has seen a bit of a dip in pricing recently, so just don't buy anything blindly and don't overpay for it. That's really important. But it's also crucial for you to understand that if you are buying an asset based on the strategy which will help you buy more assets in future, which if your aim is to build a property portfolio and not just stick with one property purchase, that is when Sydney kind of actually doesn't really help for most of the people, because that is where their cash flow gets limited. 800K, 900K townhouse would probably return 600 a week, 650, 700 a week in terms of rent. Yes, it will have growth, but future loan or future serviceability of any future loan will be highly negatively impacted. So be careful of buying in Sydney and Melbourne right now. If your target is only capital growth, and you have heaps of income, you're making huge income, you're not worried about negative gearing a lot, then yes, by all means, target some good desirable areas, good family oriented areas in Sydney and Melbourne and go for a property, because that is where your high income will still allow you to get more loan and keep building a property portfolio. And by high income, I'm saying 300, 400, 500K as a household income, right, per year. But not everyone has that kind of an income. So that's where interstate investing is the solution, where you can still buy properties for 700, 800K, even for 600K, and they will be getting you rentals of 600, 700, 800 per week, even more, and they will still give you that growth of 50 grand, 200 grand every single year potentially. So these are the places outside of Sydney where you should be targeting instead of looking at Sydney right now. We have a question from Oscar. Thanks for your question. What do you think regarding the interest rates? Very good question. I wish I had the crystal ball. I don't think RBA even has a crystal ball. I think it probably will also depend a lot on which way the interest rates go based. Of course, the local economy has slowed down in Australia, so any rise in interest rate is very unlikely. But having said that, any reduction in interest rate also looks unlikely. And to be perfectly honest with you, I will be really surprised if RBA actually decides to take the interest rate down in the next 2 to 3 months, because what can happen is they may have to bump up it again after 6 months and may have to do it once or twice, which will be more chaotic for the people. So I think the best possible strategy, that in my opinion, would be they leave the interest rate as is and they actually wait for another important factor, which is the federal election in the US and what happens over there. Because I think based on who comes as a president will have an impact on the US economy, which has a direct impact pretty much on the Australian economy as well. So I don't think interest rates should be going anywhere for the next 3 months, maybe up until Christmas as well. If they try to give some relief before Christmas and try to drop it just to make things feel a bit better by 25 basis points or so before Christmas, I would be a bit surprised, I would say. So yeah, thanks very much for that as well, for Oscar, for your question. And if there is any other question, more than happy to take them. I hope you got your answer as well, Ed. And Oscar, did you get your answer? Please drop in with a message. And I'm just reviewing some of the other questions over here. Okay, so just looking at some of the other questions. So someone has asked me, should we go buying, if we want to buy investment, should we go under a trust structure or should we buy under a personal name? Again, that is very, very specific to your scenario. Some broad level benefits of buying a property under a trust is that you get more protection of your asset. Potentially, your asset is more protected as compared to you buying it under your personal name. But for me to tell or discuss anything more on that would potentially fall into tax advice, which I'm not licensed to do. But if you really want to understand which structure would work for you, because it comes down to how much is your income, what is your long-term goal, what would your cash flow look like, how many properties you want to buy, let's say in the next 5 years, 10 years, are you looking to buy just one property or three properties or six properties? So all these questions need to be understood before someone can advise you on what structure you should go for. And the best person to advise on that is your accountant. Now, if you want to connect with the right accountant who's experienced and who can guide you into the future, feel free to DM myself, leave me a message to connect you with one of our trusted partner accountants, because that is what their field really is. But there are different types of trust that people use. There's a family trust, there's a unit trust, but I won't go into any of the details which one you should be using, because that's more around what you should be discussing with your tax accountant. Okay, so we are taking more questions, just going through the list right now. Okay, someone has asked me a question around what are your thoughts about Chinchilla in Queensland. Okay, I was expecting questions like these, and I would expect them every week. That's perfectly okay. More than happy to take them. Now, Chinchilla is a mining town, And there's a bit of a story around mining town. Thanks for your question, Dom. So how the mining towns actually work? Once the mining contracts get signed, there's a lot of activity in those towns because a lot of companies come in over there. They hire a lot of staff. They fly in a lot of staff over there, and that staff actually needs properties to rent out, and they want properties to live in, right? So once they hire the properties, suddenly the demand of properties goes up. The price of your property goes up as well if you have an investment property in mining towns. But and you can get really good rents as well. Like I know some places where the property prices went from 400k up to 800, 900 grand, and they're returning like 1200, 1400 a week, which is insane. But the problem is once the mining contract is finished, let's say the government changes or the policy changes, or for whatever reason the mining contract actually runs out, that is when these companies start vacating these towns, and these towns become ghost towns. And what that actually does is suddenly the property will become vacant. And I have seen examples where one of my client came to us who had bought a property for around 580 grand. It went all the way up to close to 950, and he was really happy. And once the mining contract was over, he was not even able to sell it for 500k. So he held on to it for 5 years. He got really good rental returns, but after 5 years, he started making huge losses on the same property. So buying in mining towns, I'm not saying you should not buy. I'm not saying that you should buy. What I'm saying is, as long as you know what are the risks involved, it's a high risk and high reward kind of a scenario. Something like NDIS as well, I would say. Again, very different types of property types, NDIS and buying in a mining town, but they both are somewhat related in terms of risk. They both have high risk because of very different reasons. Let me be very clear. And they both have high rental incomes as well. But again, that comes with a high risk as well. So if you are happy to accept that risk, go for it. But most of the people are not in a position to take that uh, brunt of 100 or 200k less than what they paid for the property. I don't think most of the people would want to do that just for the sake of high rental returns. So I would personally never invest in a mining town. I would never invest in Chinchilla or any other mining town. And I would never recommend you to do that as well. One thing more, mining towns can actually go through transformation. So Newcastle in New South Wales, which is like 2 hours north of Sydney, is a prime example. 20 years ago, it used to be a mining town only. But in the last 15, 20 years, the state government has done a lot of investment in Newcastle. Now there's a lot of farming happening around that area. There's a lot of manufacturing. There's a lot of agriculture happening. There are a lot of different industries over there. There are different types of jobs. There's a lot of construction activity. A lot of roads are being built. The highways are getting expanded, the Pacific highways. So if a mining town, now no one can say that Newcastle is a mining town because it's not. It has a lot of different kind of economic drivers. It has people who are doing jobs as a professional, who are working in the office space, who are working in administration staff, who are working as government employees. So once a town, a mining town, or any town goes through a transformation where their economy is not dependent just on one type of job sector, but now they're dependent and they have multiple types of jobs over there, that is when it's a much more trustworthy and a reliable place to put your money in for investment. That is my personal opinion, and that is based on our experience with working with 100 plus investment buyers as well. So that's what I would suggest to you. Now, no one can say that Newcastle is a mining town because it's not, right? So we are just looking if we are getting any more questions at this stage, guys. Let me go through it very, very quickly. And if we don't have any questions, we can call it a day. I'm just scrolling through some of my feed. Okay. So I believe that's it. I don't seem to have any other questions. Thank you, Dom. Thank you, Oscar. Thank you, Ed. Really, thank you to your questions. This was the very first session. Just a reminder, if you are watching it as a recording, please hit like, share, and give us your feedback. Let us know what you think about the session. What would you like to hear about? What data would you like to see? What would you like us to talk about as a topic? Would you like to talk about rent vesting? Would you want us to talk about how to build a property portfolio? Would you want to talk about how your cash flow should work? So please let us know what exactly you want to hear about, and we would like to cover those topics in future weeks as well. We'll be having this session every Tuesday, 6 p.m. Australian Eastern Standard Time. And until next Tuesday, take care, enjoy your night, and I'll see you next week. Thank you so much.